back to Money Talks. I'm Mia Lee, escort, stripper, CPA, and recovered banker. Today, I want to talk about real estate investment strategies and specifically REITs or real estate investment trusts versus direct property ownership. A lot of investors like having some real estate exposure because it's generally believed that real estate is uncorrelated to other sectors. Many of us want that portfolio diversification, but owning physical property is not the only way to get that exposure to real estate. REITs, or real estate investment trusts, provide a more hands-off approach with the potential for steady dividends and the ease of diversification. In contrast, physical property investment demands much more from the investor, but it offers you direct control. I think most of us understand what it takes to own physical property, so I want to focus more on REITs. REITs are companies that own, operate, or finance income-generating real estate across a range of property sectors. As an investor, you can buy shares in a REIT just like a stock because a REIT is a publicly traded company, and it offers you as an investor a way to invest in real estate without having to buy, manage, or finance property yourself. Let's talk about some of the types of REITs. So there are two types of REITs. There are equity REITs and mortgage REITs. I'm going to start with equity REITs because there are just more types of equity REITs. Equity REITs own and operate income-generating real estate, and the revenue mainly comes from leasing and collecting rents on these properties that equity REITs own. Within equity REITs, there are many different types of strategies, but I'm going to give you a few just for exemplary purposes. There's single-family rental home REITs. Invitation Homes has a portfolio of about 80,000, and it's focused on the Western United States, the Southeast, Texas, and Florida. Currently, it's yielding about 3.4%. I'm recording this in February of 2024. These REITs are focused on acquiring, leasing, and managing single-family homes across the U.S., and they capitalize on the demand for rental housing, offering investors exposure to the residential real estate market without the direct responsibilities of being a landlord. There are also triple net lease companies, and an example of this is a company called WP Carey, ticker WPC. WP Carey is very diversified in industrial, retail, generally very high quality buildings and tenants. This company is currently yielding about 6%. REITs focusing on triple net leases own properties that are leased to tenants under agreements that go beyond just the collection of rent. Tenants of these companies are responsible for all costs associated with the property, including maintenance, taxes, insurance, in addition to just the rent and the utilities. This is attractive from the company's perspective because it really minimizes the operational responsibilities on the part of the landlord and therefore the expenses consequent to those operational duties. There's another type of REIT that's come up in recent years with the legalization of cannabis in certain jurisdictions. These are cannabis real estate REITs. A couple of examples of this are a company called Innovation Industrial, ticker IIPR, and New Lake Capital, ticker NLCP. With the growing legalization of cannabis in various regions, some equity REITs have specialized in owning and leasing properties used for the cultivation, production, and sale of cannabis. In contrast to equity REITs, there are mortgage REITs, or MREITs, and they provide financing for income-generating real estate by purchasing or originating mortgages and mortgage-backed securities. Earnings from MREITs come from the interest on these financial assets. Let's talk about some of the ways to evaluate REITs. One of the really attractive features of REITs is their dividends. A unique feature of REITs is that they're required by law to distribute at least 90% of their taxable income to shareholders annually in the form of dividends. This can provide a really steady source of income, assuming the company is healthy. The yield, or the dividend rate compared to the company's stock price, can be a key metric for evaluating the attractiveness of a REIT for you as an investor. The yields can vary widely based on the REIT's sector, performance, and just the general economic environment. You calculate this by comparing the annual dividend payment to the REIT's share price. Another important metric for evaluating REITs is the funds from operations. The abbreviation for this is FFO. FFO measures the cash generated by the REITs, and it can be a better indicator of performance than earnings alone. It's really important to evaluate if dividends are going to be safe or in jeopardy. Another thing that's very specific to real estate companies is occupancy rates. This applies to equity REITs, not so much to mortgage REITs. The higher the occupancy rate, the stronger the demand for the REIT's properties, and the better the health of that company is going to be. Another metric that we should be looking at when evaluating all companies, not just REITs, is the debt to equity ratio. A lower ratio can indicate a healthier balance sheet and less risk to you as the investor. And then the last thing you want to look at if you're looking at investing in REITs is the sector performance of real estate overall. Different sectors like retail, healthcare, industrials can perform differently based on economic conditions that are affecting that sector, and real estate is not immune from this. Let's talk about the other side of this decision. If you decide to own physical property, if you're going to purchase residential or commercial property as an investment, it's going to require substantial capital up front. You're either buying it in cash or you're financing it, and if you're financing the property, you're still going to have to put a down payment down. There's still going to be servicing costs to paying the loan on that property, and then you're going to have to perform ongoing management. You're essentially carrying the risk of things like market fluctuations and property maintenance. The scarier part for me as someone who doesn't want to invest in physical property, will probably never invest in physical property as an investment avenue, is that you have to know about tenant protections in all the jurisdictions that you have property in. You know, going from Indiana to New York is very, very different. And I've just heard too many horror stories of tenants squatting, trashing properties, like all of this kind of stuff, that I'm just very discouraged from owning physical real estate. Very much a fan of REITs over physical property. I'm Mia Lee. You can take the girl off Wall Street, but you can't take the banker out of the whore. Drop me your comments, questions, and suggestions for future content.